Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, May 21st, 2010. Let's start today's broadcast with a look at the euro-dollar pair. The German parliament approved Germany's contribution to the 750 billion euro EU rescue plan, lending some relief to the euro, adding to the gains from the euro that we saw in the middle of the week. The German contribution can add up to 147.5 billion euros. We saw the euro gain in the middle of the week despite risk aversion and a flight from risk overall. Today's move retested the 200 period moving average and actually used it as support, climbing higher to test the 1.26 area around the close. We'll see if this rally can last past the weekend, as there were some positive developments in the sovereign debt saga this week, in addition to the aforementioned Germany parliamentary decision. For instance, on Tuesday, the Greek government received 14.5 billion euros from the European Commission and another 5.5 billion from the IMF, representing the first disbursement of bilateral loans as part of the Greek rescue package. Greece then used that first tranche of EU and IMF emergency loans to fully repay a 10-year 8.5 billion euro bond that matured on Wednesday. We must remember that that was one of the main causes that the Greek aid package was put together and approved earlier this month. Also, on Thursday, Spain raised 3.42 billion euros in an auction of 10-year bonds that analysts deemed encouraging amid concerns about the country's overall debt load. It then also approved a 15 billion euro austerity plan to rein in the public deficit. So, slowly but surely, the aid is getting out to the countries that need it, and they are putting in place austerity measures and are still getting some financing from the markets. Of course, on the other hand, we did have the German financial regulator banning naked shorts, which did send risk appetite into a tailspin on Thursday, and that created a very sharp retraction in carry trade that we'll take a look at in a second. Earlier in the week, we had signaled this level as an important level of support turn resistance, and while we did manage to move above it in today's trading, we did fall below that 1.26 level by the end of the New York session. So we are running up against this level, and it'll be important to see where we move once we come back from the weekend. If we take a look at a Fibonacci retracement of our most recent downswing, we see that we did also move slightly above the 50% retracement level, but we dipped back below in the New York session. So again, a lot will depend on what happens after we come back from the weekend, as today was likely another day of position squaring and some short covering following the rise in the euro the previous two sessions. Switching over to the pound dollar, here we see that for the most part we had been trading in a bit of a consolidation rectangle, and so unlike in the euro dollar where we actually were gaining, this is a much more sideways price action for the week, and that suggests that the pound is a little bit weaker than the euro to end the week. However, we do test our resistance now at the 1.4475 level, 1.45 level, which was our lows back here in May 7th, and we'll see if the pair has enough strength to actually move above that level or not. Comparing the euro against the pound, we see a move in favor of the euro in the second half of this week, following some sideways consolidation during the first half of the week. So we came close to testing our levels from May 7th as well, though after we hit the 0.8772 level, we did consolidate some of these gains from the middle of the week. Looking at one of the hard-hit currencies from the flight from risk that we saw yesterday, we're looking at the Aussie versus the yen, and as we can see in today's trading, after setting a bottom at 72.50 or a low here, support at 72.50, we rallied during the Asian session and then consolidated during the rest of trading using our 50-period moving average as resistance, as well as the 75.50 level. So that is some stabilization and consolidation of losses in this pair or gains for the yen. Now, we did have the Japanese finance minister say that excessive strengthening of the Japanese currency isn't desirable, which gave some indication to the markets that Japan might intervene if the yen strengthens too much. So that paused this decline we have been seeing in the pair, though overall the risk conditions lightened up somewhat heading into the weekend compared to what we had seen on Wednesdays and Thursday. Also, U.S. equities during the morning trading and throughout most of the afternoon were positive, which helped to lend some appetite to risk. In our last market highlight, another commodity currency pair, the US dollar Canadian dollar, We saw that we had tested the 1.0750 level twice in today's trading, but then the pair succumbed to the sense of slight risk appetite, or at least position squaring heading into the weekend, and we saw the Canadian dollar gain down to the 1.0550 level, which was pretty close to our old resistance that was broken earlier in the week. Zooming this pair out, we had already noticed our highs from May 6th at the 1.0750 level, and we could see that that level did hold as resistance in today's trading. Now, fundamentals did help the Canadian dollar in today's New York session, though overall fundamental releases are just not very important or key drivers in currency markets, but still it helped the Canadian dollar. So let's take a look at those releases. The Consumer Price Index rose 1.8% on the year in the month of April, faster than the 1.4% the previous month, and forecasts of a 1.7% rise. The increase in prices were primarily led by cars and gasoline price increases. On the month, prices were up 0.3%, and if we look at the core values, we also had higher than what we had seen in March, as well as higher than forecast readings. In a second report, we saw that retail sales in Canada increased to a record 37 billion Canadian dollars and above expectations of a 0.1% advance. In fact, we saw a climb of 2.1% in sales. Core sales, which take out automobile purchases, rose 1.7%, so underlying strength in retail sales as well. So the two releases together, higher inflation and higher retail sales, give the central bank more scope to begin raising interest rates as soon as next month. So maybe after the dust settles with all the risk aversion, and if we see commodity prices stabilize or even begin to rise, the underlying fundamentals are there to support a rate hike and to support the Canadian dollar going forward. While investors' sentiment and risk appetite and aversion will continue to be the main drivers of currency markets, let's see what fundamentals we can look for in next week. From the U.S., we're going to get data on home sales and the housing market. As Monday, we have existing home sales, and Wednesday, we get measures on new home sales. We're also going to see consumer confidence data on Tuesday, as well as personal income and spending data on Friday, giving us a better view of the consumer. Also, we get the second version of our first quarter GDP on Thursday, as well as a measure of durable goods orders, measure of manufacturing, as well as consumption demand on Wednesday. Around the world, UK posts its revised GDP version for first quarter on Tuesday, while the Eurozone releases its industrial new orders. Wednesday, we get the Australian private capital expenditure. Thursday, UK posts a measure of retail sales, and Japan will post its end of the month statistics on CPI, unemployment rate, retail sales, and household spending. Finally, we end the week with the Switzerland KOF leading index. And that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site at cmsforex.com. I want to thank you for watching and wish you a great weekend.